Hello and welcome to Views from the Top. I'm Sarah Allen and today I'm joined by Cory Martin. Cory is the CEO, Executive Director and Equities Portfolio Manager for Barrow Hanley. Today we're going to have a chat about which way markets are headed, and we're also going to touch on that old growth versus value debate. Welcome, Cory, and thank you for joining us.
Thank you for having me.
So to start with, growth versus value. Why do you focus on value?
Well, we've been a value manager for 46 years, and there's no question that value discipline is superior in terms of providing excess returns over growth. There are periods like we've just seen, and we saw another one in 97, 8, and 9, where we have significant growth rallies, but over the long run, value will deliver. And so we're committed to that. I think the last 10 years has been an anomaly in the market, where we've had a very narrow market driven by the biggest tech companies out there. We all know who the Magnificent Seven are, and it's been sort of a false fiscal and monetary environment where we had low growth globally, we had zero interest rate policies globally, we had no inflation, and that is the perfect fuel for long duration growth assets and many of the smaller growth companies where they have no cost of capital, and so even if they're not really profitable, they can still thrive in that environment. That environment is largely over now, and we can talk about that more later.
Okay, and so we finally saw value start to outperform in the last couple of years, and then lo and behold, 2023 hits, and suddenly growth is back in the game. Where are we in the cycle?
Yeah, so we actually think we're in the early stages of a value cycle, and it's not uncommon to have a strong growth rally within a secular value cycle. So if you think back, coming out of the tech bubble in 1999, in 2000, 2001, 2002, 2003, it was a very strong value rally that really lasted until 2008 in the GFC. But during that time, 2002 and 2003, we had very strong short growth rallies like we've just witnessed with the Magnificent Seven. The opposite is true in growth-led markets. So if you think about the last 10 years where growth has been the dominant player since the GFC, all the way up into 2020. During that period, we also had the reverse. So in the latter half of 2016 and all of 2017, we had a massive outperformance of value relative to growth, and then the growth rally resumed, given that the fiscal backdrop and monetary backdrop that I described earlier. Okay,
and where do you think markets are going to head in the coming year?
Yeah, it's tough to know. What we do know is the majority of the return over the past 9 to 12 months has been in 7 stocks, the Magnificent Seven. And if you think about those stocks, year to date, they're up about 68% through mid-November, and the S&P 500 is up about 1.5%. The rest of the stocks have underperformed. So one of the things that's creating opportunity, not just for value managers, but for really all active managers, even quality growth managers, is when you get in a market that is so narrowly driven, where the majority of the broad market return is only a few handful of stocks, what that does is it provides massive dislocations in valuations for the rest of the market. And think of it this way, if you took the Magnificent Seven stocks and you made them their own sector, it would be 28% of the market cap of the S&P 500. Think about that. That's a huge number. So it'd be 28% of the S&P 500, yet it would only be 17% of the earnings. So keep that figure in mind. The next distant second is the financial sector. So the financial sector is 13.1% or 13.2% of the S&P 500, yet contributes 21% of the earnings. So the market cap relative to the earnings contribution is far superior than the Magnificent Seven relative to their earnings contribution. Another area that we are very interested in is if you look at energy. Energy is about 4.5 or 4.6% of the S&P 500, yet it's 11% of the earnings. And so, this distortion in the market is creating a lot of opportunity, and in terms of valuations for the rest of the market for active managers to exploit.
So you've just touched on a couple of the dislocations you're seeing in the market. How are you taking advantage of those?
Yeah, well, right now, so what has happened is we've had a significant rally in the growth side of the market. But what else is participating in that? There's cyclical names in general. So higher beta, cyclical names. And so We're participating in that by we've had a pretty significant weighting to cyclical names in our portfolio. They've rallied significantly over time. They've become more expensive, and whenever that happens, the opposite end of the spectrum are more defensive compounder type names, and so those names now are cheaper relative to some of the higher beta cyclical names, and we've been taking the opportunity to rotate and take profits in the cyclical area of the market, redeploy in the more defensive areas of the market, which are staples, healthcare. We've added some utility exposure. These are not defensive names or compounders, but we've added a significant exposure to the materials sector, which has underperformed pretty dramatically. So we've been quite active in rotating the portfolio and really with the view into cheaper areas of the market, higher upside. We've done some swaps and sort of high grading names that we already own for maybe higher quality, higher expected return names with all these dislocations. So it's providing a great opportunity to really be active.
And you mentioned a few defensive plays in there. On the whole, would you say you're more defensive or on the offense at the moment?
Well, currently we've gone from a little bit sort of equal weight defensive versus cyclical, and we've been trimming some of the cyclical names, and I would say we're about 55% defensive, 45% cyclical at the moment. But each of the investments, we don't really think about it as, that's how you classify them, but each of them have their own idiosyncratic drivers of earnings and profitability, and just because they're on one end of the spectrum or the other, you can win at the same time on both ends of the spectrum if you pick the right stocks.
Okay, now financials is a fifth of the portfolio, so that's the biggest sector weighting. What value opportunities are you seeing in that sector?
Yeah, so financials are a large component of the broad market. They're an extremely large component of all value benchmarks. We've been about 20% up until September in the financial sector, slightly underweight relative to the value benchmark. We're now down to about 15%. And so we've been pretty active in selling some of the financial names that had worked, particularly banks that had worked. And really now we're down to about 15% exposure to financials. About 7% of that is in banks. Within the banks, about half of those are in the U.S. and the other half are outside the U.S. And the outside of the U.S. banks are primarily in either Hong Kong or other emerging markets like Brazil or Thailand, where we have the opportunity to buy really cheap banks at half of book value that are super high quality, well managed, well capitalized, have strong net interest margins, strong market share, particularly the Brazilian and Thai banks. So we've been taking the weight down and just taking a different tact on where we're getting exposure. The other half, about 6.5% of our financials exposure is in insurance companies. About 85% of those are in the U.S., and those have been a really good place to be.
What are the particular opportunities you're seeing in the insurance space that are making them appealing?
Well, it's become a hard market, and their pricing power has gotten better. The types of companies we own are primarily property and casualty, and we stayed away from sort of the reinsurers and the other areas. But I think it's an improved market. They have a lot of pricing power. You've seen, well, if you're not from the U.S., you wouldn't know, but in a lot of the coastal regions, the pricing has gotten so outrageous that it's become quite profitable. In Florida, it's actually become very difficult to even get home insurance, for example. But that is a backdrop that's been very favorable to pricing power for insurance companies, and so they've been able to take advantage of that.
Okay, so taking a different approach now. So a lot of the biggest opportunities that we often talk about are in the big growth tech stocks, especially the AI-driven ones. How do you approach that from a value perspective? Yeah,
so we've actually been able to do that in ways that are not on the surface apparent. So the big growth tech names are world-class, life-changing companies. We would love to own them. We have owned them in the past. We own Microsoft. I think we owned Microsoft for like 12 years, up until a few years ago, and it got just too expensive for what our clients pay us to do. We will get a chance to buy the Magnificent Seven, at least some of them again. In 2000, we were told you'll never own any tech names, and by 2004, we had 18% of the portfolio in tech. So we're just patient, and so what we're not going to do is chase some of these tech names that have AI exposure where the multiples are just outrageously high. So what are we going to do? If we can exploit a theme related to that in other areas of the market, we will do that. For example, We own an industrial company, and I can't talk about stocks here, but we own an industrial company that on the surface looks like it would have no relationship to AI at all. Well, they're the biggest provider of cooling and liquid cooling systems for data centers, the biggest in the US. And so that stock's actually up 200% this year, so it's outperformed the Magnificent Seven. So there are ways. We've got another industrial company that is the biggest provider of high voltage connectivity connectors and also wiring. And so on the surface, they appear like a boring sort of industrial company, but they are a leader in EV development. And so they've also got a division that is a leader in LiDAR, radar, and other sensors. And they also are a leader, almost a tech component of the company, even though it's an industrial, that is a leader in sort of the customer infotainment experience within an automobile. And so they are very connected to the growth in autonomous driving. They're very connected to everything happening in EV altogether. And so there are ways that a value manager can play in these sort of sexier areas of the market that are hyped up. We just don't want to do it at a high multiple. And so we have to be very careful and smart about where we're going and finding opportunity that is involved in these areas of the business that we're almost getting for free. And so that's a classic value play.
So it's about thinking a bit differently, looking
Right.
below the surface.
Right.
Okay. And what are some of the trends you're most excited about or most concerned about in the market today?
Yeah. So I'll talk about excitement first. So what we're seeing, I'm going to go back to this theme of the market has been so narrow that there's a huge opportunity set of cheaply priced companies to buy. In fact, a lot of these names that we're looking at are back to pandemic level lows, which is hard to believe because everything's been moving around. So very excited about that. Opportunity set's as good as it's ever been for us. And that's across the board in all of our strategies, not only global, but EM, US, and everything else. Still concerned about the narrowness of the market on one hand. So I'm concerned about the narrowness of the market. That's a positive for us, but it's not a positive for the broad market. It's a positive for other active managers, but the broad market indices are prone to a sell-off given the narrowness. If those aren't working, the broad market's not going to work. Also, it's interesting to me that 9 months ago, the consensus belief was that rates are going to stay higher for longer, and the Feds could even possibly continue to increase rates. The last 3 months, that's completely flipped, and now it's 100%. There's a 100% consensus that the Fed's done in the U.S. And that rates are going to be cut aggressively in 2024. I'm not necessarily a believer in that. It's a possible, but one thing that you know by history is when we've gone through these inflationary spikes globally, generally there's an attack through monetary policy. Generally inflation abates, which we're seeing now, but over 80% of the time inflation reasserts itself. And so to have everyone 100% consensus on this is what's going to happen, not so sure about that. That's priced into the market, though. The other thing that's priced into the market is the fact that the Fed's going to engineer a miraculous soft landing, which they've never done, by the way, in an effective manner, and that everything's going to be okay and we're going to avoid a recession. That's also priced into the market. Well, we've just gone through the most extreme inverted yield curve environment and the longest in many, many years, if not ever. 100% of the time when you've got an inverted yield curve, there is a recession. Could be mild, not saying it's going to be bad, but for 100% consensus to say everything's Goldilocks and going to be fine, we're going to have a soft landing, that gives me caution. So what does that mean from a stock selection perspective? It means that we're bottom-up stock pickers. So we think about these things, but we really translate if we're wrong and there is a black swan event or we have a massive recession, or all of the names that we are holding, do they have the balance sheets to withstand something like that? And I can talk more about that in a bit. But so those are the things that I'm concerned about. Those are the things that we're excited about. Opportunity set is getting bigger.
So when do you think a recession might hit?
I have no idea. So I'm not a macroeconomist. We really try to avoid any kind of top-down macro binomial prediction because usually we're wrong and everybody's wrong. I do know this. I do know that the effects of a rapid interest rate rise by a federal, a bank like the Fed, there's generally a 12 to 18 month lag after the last raise in interest. We're not there yet. And so the cost of capital filtering through corporate America is really not reflected yet. I think it's starting to happen on the small cap end of the market. It's certainly happened in small cap energy, where the cost of capital is over 12% now. Those things have not happened yet, and it's hard to predict what impact that will have in terms of recession and the timing of that. And again, we may not have a recession, but we have to think as investors, what if we do? How bad could it get? And the companies that we're looking at or own in our portfolio, can they withstand a shock like that?
Well, finally, what I want to ask you is, what's an insight that you've recently learned that you wouldn't have known had it not been for your position that you could share with us today? What's your view from the top?
Yeah. Well, I think this isn't a recent realization. This is something over 35 years that I've realized, is that investing has two components. Most of the time, analysts and investors think about, okay, I've got this stock idea. Here's my thesis. If my thesis is right, man, this is up 50% or even 100 times, or even a two-bagger up 200%. And the stock's cheap. And you think, well, how bad? What if you're wrong? Oh, the stock's so cheap it can only go down maybe 10%. So the thing that I've learned over the years is there's just as much risk in a stock on the downside if you're wrong, maybe even more than if you're right. So at Barrow Hanley, one of the things we do, like everyone else, is we set price targets. We're doing all of our own fundamental work. And we're saying if we're right and these things materialize, the stock could be up 50% or 100% or 200%. We spend an equal amount of time, and a lot of managers don't do this, on thinking about trying to build a 95% confidence level that if something goes wrong, like there's a GFC event, there's another pandemic where GDP goes to zero, companies' earnings in many cases could go to zero, like a SeaWorld or something like that. Does the company have a balance sheet strong enough to withstand something like that if we're wrong? Given the upside optionality versus this potential downside, what is the appropriate price to pay for that stock? Understanding the price and understanding if we get it wrong, how bad could it be? How many basis points do we want to risk in this name within the portfolio? And what is the correct position size? Understanding the upside versus the downside. And we call that upside optionality. And that factors into a very focused effort on our part on the portfolio construction. And what has resulted from that is a very disciplined approach to portfolio construction and I would say, smoother return pattern than many of our peers that are just focused more on the upside. And I think that that's a discipline that a lot of investors don't pay attention to. There's a lot of hubris in the industry. Analysts tend to get wed to their names, and even our own analysts, we've talked to them about how bad could it get, and we're like, maybe 10%. And we're just like, how about we go back to a GFC and start at maybe 50% decline? And the other thing that we think a lot about within this context of asymmetric return profile, if we build a portfolio of individual stocks that have a more favorable upside relative to downside, that's a positively skewed asymmetrical outlook, the whole portfolio is going to be structured that way. In other words, you're going to participate in the upside when the market goes up, and you're going to protect to some degree. You'll go down, but you're going to protect to some degree when the market rolls over. And I think we've had a very successful 45 plus year record of providing that kind of return pattern.
Okay, there's some really good insights for our listeners to take on. Thank you so much for sharing your insights with us today.
Thank you for having me. I appreciate it.
And if you've enjoyed that interview, please subscribe to Livewire Markets or Market Index. Thank you for watching.